Welcome to the Techno Fundamental Report for February the 19th. Warren Buffett says the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Benjamin Graham says the investor's chief problem, and even his worst enemy, is likely to be himself. Warren Buffett, the stock market is a device for transferring money from the impatient to the patient. So all three of these quotes have to do with human behavior. And what Buffett is trying to say here about this third quote is, meaning transferring money from the impatient to the patient, is that there is no investment strategy out there that I know of, after doing this for 50 years, that works all the time. There is no such thing. If there was a strategy that worked all the time, then everybody would use it and then it wouldn't work. So my point is that when your strategy that you believe in stops working, which is going to happen, you have to be patient, because at some point your strategy will work if it's a good strategy. So you have to be patient and wait for the turn. Basically, you have to wait for the setup. The market rewards discipline, not desperation. Patience pays more than prediction. So what Livermore says is that you have to wait for the setup. So sometimes that requires that you have to put the foot on the brake a little bit. You have to slow down, wait for the setup. Don't push and don't force it. Now on buy and hold, I know it's a popular strategy. A lot of people have been very successful with buy and hold. But sometimes it doesn't work, sometimes it does work. Like in the case of my grandfather, he bought New York Central Railroad. They went bankrupt, didn't work. My dad, however, bought Standard Oil, Exxon. It worked, everything was fine. But the point is, things change. The railroads went out of business because the automobiles came on and the airlines came on. So things change. You just have to be aware of that. Now, the recent third quarter, real GDP beat consensus by 1.5%, which is the largest beat in the past decade. As for AI-induced productivity, the U.S. economy delivered one of the most significant upside surprises in recent memory. Real GDP growth in third quarter 2025 beat consistent estimates by 1.5 percentage point, the largest positive beat in the past 10 years. So you can see here that the GDP numbers were very good. So third quarter was positive. So let's take a look at the market. Here's the NASDAQ. You can see we've rolled over and we've made a low. We rallied, made a lower low. So we're kind of stuck in no man's land with the NASDAQ. The NASDAQ index is probably the weakest index out there right now, which is a very important sign. Now the S&P is holding up a little better. You know, we had the pullback, the rally, and the pullback, but it wasn't as deep as the NASDAQ. So what's happening here is the market's starting to broaden out. And we can see that in some of our charts. Now, on the aggression index, I wanted to go back and look at it historically because I do think this is a very important indicator. It's a warning indicator. It's an indicator designed to give you a warning about things. So it's the NASDAQ divided by the consumer staples. So aggressive divided by defensive. When the defensive starts to rule, meaning that institutions are moving their money into defensive stocks, you can see what happens. You get a major break. Now, this was an indication of the bear market that took place in 2022 and ended around the beginning of 23. Now, we're seeing a very similar drop here. So this is a warning. It's just telling you that the institutions are moving their money into areas other than growth. So take a look at the same indicator. You can see here that both the moving averages have turned decisively down. We've gotten the death cross. We made a low. We tried to rally, made a lower low. So this means to me that, you know, the market is starting to go through some changes here because the NASDAQ is no longer the leading indicator. So if you look at the small caps, now the S&P 600 is basically companies that are valued with a market cap at about $9 billion. So these are not tiny companies. And they're pretty good companies, in fact. But I'm comparing them as a ratio to the Vanguard Mega Cap Growth Fund, which is mainly Mag 7. The Mag 7 has driven the S&P 500 for the last 3 years. So you can see what's happening here. This is a comparison. So when the line's going down, it means that the small caps are underperforming. And they've been underperforming here for 3 years. Now, you see here where we would get a rally, and we'd actually get a golden cross on the moving averages, but then it immediately failed. We would get a rally, immediately fail. We would get a rally, fail. So we've been getting a lot of false signals on the small caps, but this time around is different. We've gotten the golden cross. We've broken above the trend line. We've made a high. We pulled back, made a higher low. Then we made a higher high, and we're making a higher low. Then we're breaking out to our higher high. So the small caps are definitely starting to show some life. This is because the market is starting to broaden out. Now, if we look at the mid-cap stocks, which are a little larger, around 20 billion, you're seeing the same thing. So the domination by the Mag 7 may be coming to an end, and you're going to have to open your mind up to new and different opportunities. Like I say, things change. Now, this is the ARK Fund. This is a fairly famous growth fund that had a phenomenal period, but it's really been having difficulties here. It's made a high here back in October, came down, rallied, failed, and then came down again. So you can see here with the ARK Fund, growth stocks just continue to have difficulty. Interest rates continue to stay stable. For the last 125 trading days, the 5-year Treasury yield has dropped by 4.63%. So interest rates, if anything, they're stable, which is a very big positive. Also, looking at the 200-day moving average, the primary trend continues to be up. So we're still in a bull market. It's just that we're going through rotation and a transition away from tech stocks and into other areas, which needed to happen because we need the economy to broaden out. Crude oil continues to stay in a downtrend. I just think this is an important thing to note. We recently rallied up to the trend line, failed, and now we're rallying up to the trend line again and failing. So as you can see here, the way you define a downtrend is you make a high, then you make a low, then you make a lower high and a lower low. So oil is definitely in a downtrend. Now, on new lows on the New York Stock Exchange, we're still seeing elevated levels here. That is not good. Anytime we get above 40 a day, that's troubling. It just means that the sellers are pretty much in control of the market at this time. So all in all, the indicators are looking iffy. The market looks iffy, but there are certain stocks out there that are starting to show promise, mainly in areas like travel and areas like that. The consumer staples have been strong, but that's kind of a defensive thing. So if you have any questions, please let me know. Thank you very much.